Hi there, welcome to Kneppy Invest. So this is the third series in my Kneppy Invest USA. So I've already done Amazon and Apple, and I thought why not just remain on the A-themed companies. So today I'm going to look at Alphabet, and for those who don't know or have been living in a cave for the past 20 years, Alphabet is the sort of the parent company of Google. And I'm pretty sure everyone who is watching this video has used Google before. And in fact, they've probably even said the words, can you please Google that? Or I'm going to Google that. So Google's become part of our everyday vocabulary in a way. And I think that's a sign that a company has really made it. So the question becomes, is Alphabet a buy for me? Just me, not for you. I'm learning a lot from these videos. So even though these are probably my least viewed videos, the fact that I'm learning a lot is good enough for me. And if one person out there who watches this video gets something from it, that's good enough. Just one person. That's all I want. One person. So what I'm going to do in this video is go through the charts, go through the financials, and then ask the question to myself. And maybe I'll come up with an answer. So let's get to the first chart, 16-year monthly chart. So my previous two videos, I looked at the 15-year weekly chart, but it was too cluttered. I didn't really like it, so I thought I'd just go to the monthly chart. And this just shows you exactly what you want to look for a long-term holding. A chart or share price that goes from the bottom left to the top right. That tells you that your holdings within a company, if you held it for that 15 years, has grown substantially. And that's definitely what's happened to Alphabet shareholders. If they've held far or solid for the past 15 years, they've seen their holdings compound at a 14% annual growth rate, which is not bad at all. So probably one concern here is it's looking like it's sort of going into an exponential growth. An exponential growth of share price or anything is not the best thing because that's not sustainable in the long term. It eventually has to slow down. And once it slows down, that could be a sign the company is entering the mature stage of its life cycle. And that could be the time when you start to think of selling out because growth slows down. And eventually the growth becomes negative or even doesn't grow at all. So I don't think Alphabet has reached that point yet, but you never know. When you look at the 1 year daily, so nothing too much to get out of this. It's still in a good uptrend here. We've seen those pullbacks, which would have been really good times to buy during the COVID-19 financial panic. Another pullback in September and October, so that would have been a good time to buy. It's nearly at all-time highs now, not far off it. So a good trend here looks like. So nothing too wrong with this chart at all. If you're a holder, you'd be very happy with the performance of Alphabet. Now let's get into the financials. And this is what I really like to see. So what I've done here is looked at the past 15 years, share price, revenue, profit, and operating cash flow. The main thing I want to see here is growth year on year, especially for revenue, profit, and operating cash flow. We definitely see that. In fact, share price growth over the past 15 years has been 9 times. So it's been just short of a 10 bagger, but 9-time growth with the share price is not bad over a 15-year period. But one interesting thing is we've seen revenue, profit, and operating cash flow grow at significantly more or higher rates than share price growth, which also suggests to me, you can just see revenue's gone from $6 to $171 billion, which is, a growth rate of about just shy of 30 times, about 28 times or so. And that's way more than share price growth. So that probably suggests that the share price growth has a little bit more in it to match, specifically because it has to match eventually revenue, profit, and operating cash flow growth. So the other thing I've taken from this is over the past year, from 2019, the third quarter, to the current third quarter in 2020, we've seen the growth rates actually slow down a bit. So you can see operating cash flow has gone from 54.5 to 56.8. Profit hasn't grown by much. Revenue has gone from 161 to 171 billion. Share price growth has been quite significant though. So share price growth over the past year has been significantly more than those other three. So I think share price growth has really caught up to the growth rate of the other three in the past year. So I decided to graph all this, and this is the graph. So what I'm looking for here is exponential growth of operating cash flow and revenue to match the share price exponential growth we've seen. It also shows you that in the past year or so, which is the TTM, trading 12 months, we've seen a bit of a slowdown in the growth of revenue and operating cash flow. So that exponential growth, it's just fallen short of that. So this could be the first sign of Alphabet maturing into a mature company that is just in it to give dividends to their holders. I don't think it's reached that point yet, but you never know. The table on the right is, I'm just looking at the compound annual growth rates of revenue, profit, and operating cash flow and share price. The one thing I want to look for here is either operating cash flow and share price growth to be very similar, or operating cash flow growth to be more than the share price growth, which would suggest to me that share price has the potential to grow at more, or it has more room to grow in the future. So over the last 15 years, you can see operating cash flow has grown at 25%, while share price growth has only grown by 14%. So that suggests to me that over the last 15 years, share price has not grown by as much as operating cash flow, and we knew that looking at that table in the previous slide, but this just shows you. But over the last 5 years, share price growth has caught up to operating cash flow growth, so it's catching up. So right now, we've seen that catch up, and definitely in the past year, we've definitely seen that catch up. So this share price run we've seen the past year or so has just been to catch up to the growth rates of revenue, profit, and operating cash flow. It's not getting ahead of itself. That's probably the best way to put it. So if anyone's saying that Alphabet is overvalued, I would suggest or argue that it's just the share price catching up to the growth rate of those three things I've been talking about. So, and the growth rates of everything here is looking really good. This is sort of growth rates you really want to see in the companies you hold. So very impressive growth rates for Alphabet. Now, I do look at some of the valuation metrics, so that PE ratio, price to book, price to sales, and my favorite, EV over operating cash flow. If you go back to 2005, there would have been value investors running for the hills saying, why would you buy Alphabet? Look how highly valued, it's just too overvalued. Something very similar to what they're saying about Tesla right now. Anyway, but if you bought in 2005 at a PE ratio of 82.6, you've seen your portfolio of Alphabet grow at 14% per year. That's not too shabby. In fact, it's grown 20% per year in the last 5. So just because the PE ratio might be high, if a company grows, it just means, it can catch up to that PE ratio, especially if it's growing quite quickly, which Alphabet is doing. So never be scared about buying into a growth company that has a high PE ratio. That's the thing about, that's what this should show you, that don't be scared, because if it's growing at a good clip, good rate, it's going to justify that high valuation. So, and this just shows you, Alphabet just shows you that over the last 15 years. So right now we've seen the PE ratio about 35, EV operating cash flow about 20. So it's on the high end of its historical PE ratio, but nothing too significant. And I think there is potential that this company growing at good clips or continue good clips in the future. So will I invest in Alphabet? I think this comes down to expectations for continued growth in the future. So I don't know much about Alphabet. I use their product all the time, but I don't know about their potential growth factors or growth areas in the future. And I'm going to have to do more research. So that probably comes down to that. A little bit more research needed in Alphabet. They do have that solid, consistent growth during the past 15 years. I just want to see if that can continue somehow through growth initiatives that they've implemented in the last few years. It does look expensive when we look at some of those valuation metrics, but again, the growth rate has justified that valuation. So even though it looks expensive, it's maybe not all that expensive if Alphabet can continue to grow over the next few years or the next decade or so. We have seen, probably the one little concern is exponential growth in operating cash flow and revenue has slowed down in the past year or so, but that could be just because of COVID-19. So I'm really going to be interested in the next quarter's results for Alphabet and can see if growth rates have quickened in that last quarter or the current quarter we're actually in right now. If I had to rank the three companies I've looked at, Amazon, Alphabet, and Apple, probably rank Amazon ahead of Alphabet and Apple. It really impressed me. It actually surprised me how impressed I was with Amazon. I'd put Alphabet second and then Apple third. And of course, everyone who's watching this video should have a different sort of ranking of those three companies. You might have the same ranking as me, but if you have Apple first, that's no big deal, because these are three wonderful companies that, are three of the biggest companies in the world, and there's a reason they're three of the biggest companies in the world. So what I'm going to do for the future with Alphabet is put it onto a watch list. a buy watch list, and just wait for any significant price weakness. So if the share price pulls back a fair bit, that's when you might take a position, because we always see the share price pullback in any companies, and that's when you could enter. And the whole buy the dip, it's become a very popular motto over the past 8 months or so. Buy the dip is a thing, and in Alphabet's case, it could be a good thing. So that's all I've got on Kneppy Invest USA Alphabet Edition. Hope you've enjoyed this video. I found I did learn a fair bit about this company, just looking at financials, and maybe not as excited as it was about Amazon, but fantastic growth rates in Alphabet, and there is potential we're going to see significant growth rates in the future. So if you have any questions about Alphabet, or if you think I'm nuts for even thinking about buying this company, or if you have questions why I don't hold this company already, leave it in the comment section. If you think Alphabet is, or have a different ranking of those 3 companies, leave it in the comment section. I like to see different opinions than myself. And again, I'm not a financial advisor, so if you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's all for today. Have a good day. See you later. Bye.